Welcome. Thanks for joining in today's session. In the last video, we understood how the index funds in overall, say for example, the videos which I shared with the clips, which is pretty much related to the US market. So, but then that's pretty much where we took the index funds concept. And then let's try to understand how it works in our Indian markets, whether it be in NSE, BSE markets. Now, again, I'm referring index funds. Today, in this session, we're going to talk about difference between stocks, index funds, and mutual funds. Index funds and mutual funds pretty much are the same, but the way how it works are different than picking your own stocks, which is going to give a maximum return. So, end of this video, you should be able to have a brief idea on which one you would like to choose, and that's the way forward if you have not enough of understanding in depth into the stock market. I think which would be the ideal one, since we are doing this anyways as a part-time. If you're a full-time investor and this is only the way that you are making the first generating income, then you should pretty much already done your own research. But these are the things that you can do as a secondary income. What we are discussing is that how you can generate the secondary income with the 10-15% of the savings what you can do from today onwards, so that it will give you a good returns compared to the basic savings account. So let's try to understand quickly, and I don't want to take too much time because we pretty much discussed in length in all those videos, but I just wanted to see how your understanding can take you little further in terms of index funds. Again, everybody has their own views, and I'm giving my views, and then you apply your own logic. I will not say that index funds are the best that you could do. Again, it depends on how long you want to keep it, and if you want a short-term returns, there's a different things you need to approach. If you have a long-term, pretty much this would be ideal, either it be it mutual funds or index funds. So again, as I said, it's all about mixed views in a sense. And then people like S&P 500 is what in US pretty much in the last videos which you have watched. So where it has a diversified portfolio of 500 companies, that's where you can name it Vanguard is invested, or Charles Schwab's funds into S&P 500. Now, if you compare to that in India, and we have only Nifty 50 fund or next 50 fund, and then recently one or two funds, you might see that 500 funds, but then pretty much not too many people have hopes on that one. So even though it's a Nifty 50 or next 50, so that we're talking about only 100 businesses. You are buying an index fund in 100 businesses compared to the 500 businesses in USA, some of those funds with the S&P 500. So we pretty much have a 50 or 100, and then lately, a year back, there are some funds which was introduced 500. But then if you look at the average returns, it's now, since it's been not tested for 10 years. So what is tested for 10 years is definitely index funds for the Nifty 50, so which is pretty much in line with the the stock markets. So as I said, people have a different views. So if you think that keeping in a 50 is not going to give you good returns, then it's up to you how you want to do it. But then pretty much all the index fund as we speak, either it's Nifty 50 or next 50 or recently added 500, which you can still look at it again, which sectors are they invested in, and what are the portfolio percentages which they had invested in, something that you should be looking at it. Now, definitely index funds are for a long-term plan. So if you're at this point of thinking about the returns for a 3 years or 5 years or less, I think index fund definitely is not for you. Pretty much you can look at mutual funds, or if you're strong enough, you can pick your own stocks based on your risk appetite. Basically, so index fund is pretty much 10 years plus is if That should be your long-term goal, because we're talking about only the long-term goals. We're not talking about getting rich quick. Like you give 1 lakh today, and then less than a year, it is going to turn out to be 10 lakhs. So that's not the case we're talking about. We're talking about a slow, consistent, and the compound effect with just 10-15% of returns we're talking about, and then we're talking about in the index fund. Now you can always check I'm going to leave you a link below this video, where the data which is showing the existing plans. Say for example, pretty much index funds with the different companies, there are about 100 funds, but then you can see your own reviews for some of the funds last 5 years how it was doing it, and some of the funds last 10 years how it was doing, and what was the average returns. And you never see a maximum up and down or too much of fluctuations. You always see a steady growth on an average of some funds given between 12% to 16%, which is pretty much good. But then again, it's all time tested, and then you can see yourself, and then you can see how you can take those calls based on whichever the company's index fund which you would like to go. So the data and each plan, and also where they invested and how much percentage of each they invested, is something that you should be looking at it. So when I say about these index funds, and this one, returns are always in line with either NSE or BSEs based on, again, each index fund you are investing it. So it will never beat the market. Index funds are never going to go, suppose Infosys given 4,000% of returns in say 20-25 years. The NSE and BSE is not going to give that 4,000% return, because the only way you can pick is you need to find one stock or 5 stocks out of 5,000 stocks. That requires a lot of work. Unless until you're confident you're finding your own lottery ticket, then that's where you need to look at it. But it is always in line with NSE or BSEs. So suppose in the last 10 years, if NSE or BSE or the stock market giving you 15-16%, you pretty much in line with that. So you probably be in 14% range or 15% range if the funds are really doing good. But again, so it will never beat the market. And there are some mutual funds you might see that they're doing 22%, 25%, 26%. Again, depends on the again how they're doing it, because they're picking the right things, and that's why they're charging you back additional compared to the 10% to 0.50 or 60% what index fund charges are there. Now, as I said, the fees are about 10.10% to 0.60 is about index fund, but then mutual funds is anywhere between 1% to 2%. Again, in a long run, that really affects you a lot. And don't forget, any long-term capital gains, say for less than 3 years, there is a certain 15%, I believe, and then beyond 3 years is about 10% you need to be. It doesn't matter either mutual funds or index fund. You need to go pay taxes for the profits you make the moment you sell it. Say for example, if you made a profit of 1 lakh in long-term gain, pretty much you need to pay 10% of the taxes on whatever the investment. I wish they could take that burden when you have a losses, but unfortunately that's not the case. So mutual funds, you pay about 2%. Even so that means when I say 2%, even mutual funds are doing more than 16%, say 20% returns it is giving you, you're paying 2% back to the fund managers of particular fund, and then you pretty much end up having 18%. And always you need to, when you're investing in index funds, you need to look at the percentage of each fund where it is invested. So for example, you pick up any fund which is doing good, and then you see in the portfolio pretty much which are the major stocks they had invested, and pretty much they have to be in 15%. So pretty much if they say Infosys, probably they will say 8%, TCS 6%, Merit maybe 2%, or Maruti about 6%. So all 50 they invest, but then the percentage might fluctuate. So you need to see which categories it is invested. Is it too much into the banking, or is it too much into the automobile, or too much into the FMCG, etc. So based on that, again, your interest lies. Out of 100 index funds, probably you can pick where you think that the areas of that categories of promising for the future. Probably that's where you should be picking it. And pretty much now say, okay, index fund is minimal returns, mutual fund is a little bit more, but then it's expensive. But then there are another way that you don't want to get into these returns in a long run. Again, I'm saying you the long run, long run, long run. This is all for the long run, which even the stocks are long run. But then say, for example, out of 5,000 stocks, you pick five. So you need to find your own lottery there to find five and then stay long enough. That could go minus from say today 100 rupees to it can go to 1 rupee. There are many examples like that. Or from 100 rupees it can go to 10,000 rupees. Either ways it can happen. So if you think this is not going to work out for you, you pick your own five from 5,000. Just close your eyes and buy, because obviously it doesn't matter what kind of research you do, you will never know. Anyways, you might end up buying Kingfisher, Switzerland, Satyam, Jet Airways, etc. companies. You can just Google it and see where they were and then how they went bankrupt and how did it go. Or you might end up like Infosys, TCS, MRF, Maruti, and some of these was given a maximum returns to the investors. So again, this is kind of uh, buying a lottery and waiting for it to hit a jackpot. These are the steady growth. As long as you keep faith that the country is moving forward, the businesses are going to move forward. And the good news is, you will never, when I'm saying index funds, and when I say Nifty 50, you will never see today, if you look at it, in that Nifty 50, these companies. You will never see Kingfisher Airlines, Switzerland, Satyam, Jet Airways, all the stocks which are not performing, you're not going to see, because on top 50 of Nifty are the stocks which is doing extremely good out of 5,000 stocks. So that itself you have eliminated the maximum which is not doing it well. So that is not your job or my job, and they are doing it already. So that's why index funds are going to give you good returns. Suppose in 5 years down the line, out of 50 stocks which they have on top 50, if one stock is not doing well, obviously the one who is doing better is going to reach to that 50 number, and the one which is going to go. So the big businesses are going to compete all the time because they want to stay on top of it, so that it's kind of a privilege. It's kind of it's showing the growth of that company, etc. So that is the good news, is that investing in index fund, you're not going to end up investing in either losing companies. This is guaranteed. But then, hey, you're not going to beat the market like how these guys are going to give you. Again, this is 5 out of 5,000 or 50 out of 5,000. Finding one number out of it is your call and how you want to do. A simple example could be, now we talk about Google, Amazon, etc., so much, or Facebook. So, for example, today, the smart kid next to your block is going to come to me and said, hey, I have a wonderful idea, but I need to, if you could invest me, say $10,000 in my venture, in the future, it's going to give you wonderful results. Would you really going to buy it? No. We are talking about Facebook today because it's established company and everyone thinks, oh, I wish. Nothing happens. If some extremely good businesses today, even if they come to you to the door and say, okay, I'll give you 10% of my company shares, would you buy? Would you just invest $10,000? It has a potential future. Odds are you're not going to even invest $10 on this, because you don't know how it's going to hold. So people can talk many things about, oh yeah, that 30 is doing. We only talk about the things which has done extremely well, and how it would have turned. But then nobody can, if you're lucky enough to find as a plant, it's different story, to pick the stock and then keep it for some time and then luckily it did well. Otherwise, it's definitely not. See, we are only talking about, those 50 stocks which gave excellent returns and how many people succeeded. But then you never know, there are millions and millions of people who are losing or burning their hands with doing the same thing because things didn't work out the way it should work out. So, a person like you and me who has not too much of a background, doing into those, and then thank God kind of those opportunities. I wish I should have known. I mean, these were there 10 years ago, because I didn't know about these things. Otherwise, probably I would have definitely invested 5,000 to 10,000 rupees and a monthly consistently would have been good results as we speak. But unfortunately, it is never too late to start. But then again, if we keep debating and then maybe this is not good, that is not good, and then we're not going to take any action. You need to start at somewhere, some point of time, make mistakes, learn from it. And I think as we speak, index funds are the good bet we could take, again keeping a long-term perspective. And many videos are around the social media where you could see no one say that index funds or these things. Even with the matter of the fact, mutual funds, you want to see a long-term returns, you need to stay long enough. And if you keep following the market, you're not going to keep your emotions under control to keep those investments safe. I sincerely hope that was a little bit of help for you. I'm not going to stretch any of these more videos, but as and when I find some nice and interesting thoughts, probably I can do a little bit of analysis. But I think this would be able to give you a good understanding on how index funds works, and you will be able to take calls based on your judgment, based on your research, what works better for you. Thanks for tuning in, and I wish you have a wonderful day. Stay blessed and be good to good and influence the people around. Thank you so much for watching this video. And if you like this video, do subscribe and share to the people whom you think that this message would be of help. Thank you once again.